Scotiabank recently released their global outlook for 2018. And I guess I'd like to ask right off the top, in this report, you say that we're going to see the base metals grow in tandem. Tell me a little bit about aluminum, copper, nickel, and zinc. I mean, when we last spoke to you, you championed zinc as a big base metal to look out for in 2018.
Yeah, and one of the differences is, so zinc is still doing fantastic on its own merits. But what we've seen over the last, call it 3 to 4 months, is the base metals have really started to embody this this global, synchronized global economic acceleration narrative that the world is kind of seeing right now. That for the first time since the global financial crisis, all major economies, both advanced and emerging markets, are growing or seeing their growth accelerate. So the base metals are particularly tied to the global economic cycle, the global industrial cycle. The joke is always, Dr. Copper is a professor of the global industrial cycle. So what we're seeing is that those metals, on top of their organic, fundamental-driven, outlooks, you're also seeing a lot of interest in these metals grow as the global economy begins to accelerate again.
Now, I've heard this commodity supercycle being bandied around. Are we headed into another commodity supercycle, and how will it compare in terms of the magnitude to the last one, which I think was in the early 2000s, mid 2000s?
Yeah, I mean, the last commodity super cycle, if you want to call it that, kind of extended from the mid 2000s up until, depending on the commodity, the mid 2010s, from 2012 to 2014, whether you're talking the metals or the energy side. I don't know if we're heading into another super cycle, but I think we're definitely seeing the end of the last cycle behind us, and we're definitely embarking on a new cycle up. So while the last cycle was really driven by China's voracious growth and voracious demand for a lot of these metals and these energy commodities, this time it's going to be more of a broad-based. It's not just going to be China, it's going to be everyone kind of pulling it up. But because of that, there probably isn't going to be as much upside surprise on demand as there was during the last cycle.
Now, I know you focus a lot on these base metals, but I wanted to ask whether or not we're going to see these battery-linked metals, I guess, have their shining moment this year.
Yeah, so 2 years ago, 2016 was really the year of lithium, when you saw lithium prices spike. 2017 was very much the year of cobalt. Cobalt was the best performing commodity last year, up over double where it started the year. And what you're seeing with these metals is these big moves happen in large part because the narrative around global electric vehicle demand and sales outlooks are really exploding. At the same time, a lot of these markets are smaller than a market than, say, copper. And if you look at cobalt, for instance, cobalt, its supply is almost entirely driven by mining considerations in copper and nickel markets, because cobalt is actually supplied as a byproduct of these markets. So even though cobalt prices are higher, that doesn't mean people are investing in new cobalt mines, because people don't mine cobalt primarily. You are seeing some high grading of cobalt in areas of certain copper projects, but it doesn't have the same prices don't have the same driving effect on supply in a market like cobalt as they do in a market like copper. So this allows the prices to move far wider. You can exist in periods of relative oversupply or undersupply for far longer in a byproduct market than in a primary metal market.
And I know there's a lot of talk, as I'm sure you've heard as well, surrounding the electric market vehicle,
Yep.
but I understand we're going to see this lagging effect before we actually see these vehicles come to market.
Yes, definitely. So even 2020 could be a little early. I mean, we're seeing very large year-on-year growth, but from small bases. So even by a decade or so, we're still not likely going to see electric vehicles as the prime movers of the global auto fleet. But it's definitely heading in that direction. So with both knock-on effects for future anticipated oil demand as well as future anticipated metals demand. The big metals to watch in the EV space, on top of lithium and cobalt, which have the big lithium-ion batteries, and cobalt goes into batteries. But nickel is also a major input to many of these battery chemistries, and copper is going to be the winner in almost all these situations, because not just the copper in batteries, but in the electric vehicle drivetrains and the charging infrastructure, all these things are very, very copper intensive. So the copper market and the mining industry generally is getting very excited about the knock-on effects from electric vehicles to energy intensive metals like copper.
How excited should we be about oil? I mean, we saw that oil had a nice rally last year. Do you think it will continue that trend into 2018? And how high do you expect it to go?
So we definitely see oil the market is definitely tightened up. Brent prices, the global price of oil is currently resting at over $70 a barrel. So the market has definitely tightened. OPEC Plus, which is what I call OPEC and its associated producers, their program of supply constraint that started in January of last year has really worked to tighten the market. Inventories have fallen across the board. We've seen the largest drawdown in total petroleum inventories in the United States since the turn of the millennium. So these are all very, very bullish signals. However, even though I still see very sizable year-on-year gains for oil from 2017 to 2018 and into 2019, the price that it stands right now, I think, will likely fall back a little bit before we move higher again. And that's mainly for the reason that we're still modeling a slight supply surplus for the first time in a little while in the first quarter of 2018. And that may prompt a rationalization and a liquidation of some of these very exaggerated speculative long bets we've seen in the crude oil market. So that could fall back. However, as long as the market stays in backwardation, which is where prices today are more expensive than they are down the road, those speculative positions can actually stay in longer based on the way they kind of roll their yields forward. So we're modeling a fallback in the first quarter and then kind of drifting up towards $65 thereafter. But it really depends on how things go this quarter and how inventory patterns track out.
Is gold relevant? I mean, we're seeing a lot of these conversations surrounding Bitcoin. There's a new Fed coming in to the United States. How will that set the tone for gold?
So gold going forward, we see relatively range bound. I think it's still definitely relevant as an asset class and as a commodity, but I do think that the outlook in terms of price gains are relatively bound. So as a tailwind, you have a depreciating dollar. So that is all else equal going to push gold prices up. But at the same time, we see the U.S. Federal Reserve and the Bank of Canada and many other global central banks beginning to tighten rates, both in interest rates as well as winding down some of their balance sheets. So all of that should have the effect of reducing the demand for gold in a higher rate environment. So I see that higher rates will kind of keep gold capped, and a depreciating dollar will kind of pump it up, but generally trading in that $1,300 an ounce kind of range going forward.